In this video, we're going to be examining the determinants of money supply. Money supply is in principle determined by central banks. They're the ultimate source of money, either directly or indirectly. And we're going to see that they play a role in both channels. They have access to both channels, directly affecting money supply and indirectly. Whatever decision they make has important implications for the economy as a whole, for the price level, for the income level. And they've been subject of discussion for a long time because central banks in some countries are independent. They make their own decisions, and some people don't like the outcome. In some other countries, they're under the control of politicians and still make political decisions rather than making decisions that are economically beneficial. Central banks control money supply through three main channels: open market operations, reserve requirements, and the discount rate. I'm going to explain all these three in detail in a moment. But before I do that, let me draw your attention to what a bond is, because bonds play a key role in the way central banks intervene in the markets, in the money market, and shape the money market. A bond is a piece of paper which has a face value. Let's say this is a website that gives you the value of a bond in the market given the interest rate prevailing in the market and interest rate written on the face of the bond. So let's say this bond has a face value of 1,000 and the interest rate paid on that 1,000 is 4%. That means that the bond gives you $40 per year as long as you hold it. And usually bonds have also a maturity period. They are due at some point. In this case, it's 30 years. Now, if the interest rate in the market is 4%, then, and you want to save, this would be one mechanism. You buy this at $1,000 and it gives you 4% interest, exactly what you can do elsewhere. However, if the market interest rate goes down, let's say in this example, it goes down to 2%, you hold this piece of paper, it gives you $40 a year. This is much more valuable than $1,000 because if you put your money elsewhere, you're going to get a lot less. So this website actually calculates the bond price for you. The lower the market rate, the higher the bond price, because essentially the bond is giving you a fixed amount of money. When the interest rate is low, that piece of paper that brings you $40 a year is valued much more than $1,000. In this example, with 30 years maturity, it's valued as $1,447.93. There's an inverse relationship between the market interest rate and bond prices. This is the key thing that I want to emphasize here. If we lower the interest rate, the bond prices go up. Alternatively, what one can do, and this is what central banks do, they try to push up the bond prices by creating demand for them, and that ends up lowering the market rate. So here's how open market operations work. The Fed conducts open market operations when it buys and sells bonds, and this is the primary mechanism that it uses day to day to manage supply of money. When the Fed wants to increase money supply, it starts buying bonds. It takes the bond in and holds onto the bond, gives the cash to the public. The money that comes to the public starts circulating. On the other hand, if the Fed wants to reduce the money supply, it starts selling the assets that it has, the bonds that it has. So once it starts selling the bonds, it gets the cash from the public and puts it away. The bond starts circulating, but the bond, remember, is not used for as a means of exchange. People will have less cash, and therefore that's going to affect the interest rate they're going to be willing to pay to have cash. I'm going to come to that in a moment. The other two mechanisms that the Fed uses to control money supply is through reserve requirements and the discount rate. To understand these, we need to understand how the banking system works and how the Fed enters the picture there. Banks play a role, and a very important role, in supply of money, essentially through their deposit and lending activities. They take people's deposits, and based on the deposits that they receive, they give loans. Those loans become new deposits in other banks or in the same bank, and therefore checking account money goes up and money supply goes up. In modern banking system, essentially, when banks receive deposits, they keep a fraction of it and lend the rest. The reason they keep a fraction is that some money needs to stay with the bank in case people who have deposited money need their cash back, or they want to use their money in their checking account. The bank should have some cash ready to give to them or transfer to other accounts. So if $1 is deposited, some fraction of it is kept in the bank, and the rest is lent out. So loans become an additional source of money. The fraction of the deposits that is kept as reserves ready to be paid to the depositors is known as reserve ratio. And the amount of money that is created in the economy is inversely related to that reserve ratio. Because the smaller the reserve ratio, the more of the deposits that are lent out that become new deposits, and therefore that money in another bank becoming new deposit enables the other bank to also lend more, lend on a big chunk of the money. The lower the reserve ratio, the less banks keep cash, and the more they pass on to other banks to lend out, and as a result, money supply goes up very sharply. If reserve ratio is lower, money supply is larger. If the reserve ratio is higher, less money can be lent out, and as a result, money supply shrinks. Let's see how banks operate. Getting an insight into the balance sheet of the banks helps one understand how the central bank intervenes and controls the banks and controls the money supply. Also gives one some insight into how the banking system influences the economy and some sources of financial crises. Here's an example of a bank's balance sheet. In this case, in this example, we have a bank that has assets of $100 of reserves, $600 of loans, the money that has been deposited in the bank and has been lent on. And then the bank could also have some securities. These are essentially government bonds that the bank buys because loans normally are riskier, and the banks don't want to be exposing themselves to too much risk. So they buy with some of their assets, some of their deposits, they essentially lend it to the government or secure buyers, and that's why these assets are called securities. These are very low risk assets that the bank holds. So altogether, the reserves, the loans that could be risky, and then securities that are very low risk add up to the total assets of the bank. In this case, $1,000. On the liabilities side, the banks receive deposits, in this example, $750. They also may borrow money from lenders, creditors, who are buying bonds or similar notes from banks. The difference between the money deposited and the debt is that depositors have seniority. If something goes wrong with the bank and it doesn't have enough money to pay back, depositors get their money first. And creditors, those who provide the debt, have less seniority or junior. They come second. Banks also must have their own capital, owner's equity. That source of assets has least priority, has least seniority. If the bank is in trouble, that part is the part that goes first. In this example, the reserve ratio is the amount of reserves divided by the amount of deposits, which is 13.3%. You can think about the bank capital as the down payment on the money it has borrowed, and it raises the ability of the bank to absorb shocks and pay the depositors especially. It also serves the purpose of reducing excessive risk-taking by banks. If banks don't have much capital, they don't care about going under because they may not lose their own money that much. And as a result, they may be taking too much risk. In order to reduce the risk-taking behavior of the bank, which could be also affecting other banks and the financial system as a whole, there's need for bank capital, and usually the amount of capital the bank owns is regulated. There's a minimum percentage of assets that have to be provided through capital by the owners. In fact, the ratio of bank capital to total assets is an important ratio which is subject to regulation. It could be defined in different ways, but here's a common form of defining it is the ratio of bank capital to total assets. The leverage ratio indicates the use of borrowed money to supplement existing funds of the bank for lending. It shows how much equity a bank contributes for every dollar that it owes. In this example, we have the ratio of bank capital to the liabilities, total liabilities, or total assets, which are exactly the same. That's equal to 5%. This means that if something goes wrong with the loans, and some loans are not paid back, up to $50 loss of loans is going to be absorbed by bank capital. So if about 10% of loans go bad, $60 is lost, then the bank actually will not have enough assets to pay its depositors and creditors. The bank capital is going to be wiping out, and even some of the creditors may not get their money. Fractional reserve banking systems, the systems that are in place commonly in all countries, in principle are very efficient, very effective means of providing credit. However, they could also run into serious problems if too many depositors want their money back at the same time. The reserve ratio guards against that to some extent, because if more people come to take their money back, a high enough reserve ratio means that there's enough cash to give to the depositors, and there will be no problem in the way the system operates. A problem emerges if there are too many people relative to the amount of reserves being held. And that could be triggered by rumors, that could be triggered by the bank actually not having enough money, or the news about the bank not having enough assets to pay the depositors. Anything could cause trouble. If you want to look at an example of this in the old movie, It's a Wonderful Life, it should be available online. You can watch, there's a scene where a lot of people want their money back from a savings and loan association and from a small bank, and the owner of the bank tries to explain to them that he has enough assets to pay them, he doesn't just have enough cash to provide it to them. And the rumor that goes around that he's going under is not, he explains that it's not true, but the depositors want their money back. And that could itself cause the bank to go bankrupt, because If you can't pay the depositors, no new money is going to be coming to the bank, and if no new money is coming in, you can't make any money, and as a result, you start moving towards bankruptcy or basically closure of the bank. In order to avoid these kinds of crises, the Fed regulates the minimum reserve ratio. In fact, this goes back to early 20th century when the Fed was created and was given the task of regulating the reserve ratios, which is known as reserve requirement, the minimum amount of reserves that the bank should hold in liquid forms to pay their depositors. The Fed also provides liquidity just in case banks need them through its discount window to make sure that depositors can get their money back quickly if they need it. So time deposits are honored all the time. Sometimes also we call them demand deposits exactly for that purpose. They should be available upon demand. So let's look at the Fed's tools of monetary control a bit more closely. First, reserve requirements. These are the requirements or regulations on the minimum amount of reserves that banks must hold against deposits. When you deposit a certain amount, remember, certain amount of money should be kept at the bank, and the Fed requires a minimum amount of cash holding. Raising the reserves reduces money supply because the banks can't lend a whole lot of the money deposited in them. And reserve requirement could be used to reduce money supply. However, practically speaking, nowadays the reserve requirement has become a less important means of regulation. The reason is that banks practically can borrow from the central bank whenever they want, of course at a cost, but they can borrow a lot if they want to, and therefore replenish their reserves. So the reserve requirement doesn't play a whole lot of role in money supply anymore. Instead, the Fed is using other tools to control the banking system. The Fed in particular is interested in regulating banks' capital and some other features, especially regarding risk, to reduce the risk of insolvency or banking crisis. A very important means of regulation of the banks nowadays is capital adequacy ratio. This is the ratio of a bank's capital to its risk-weighted assets. It's similar to the leverage ratio, but this time, rather than using the total assets of the bank, we're using the risk-weighted assets. So the two concepts are related to each other, except that capital adequacy ratio takes account of risk. It is related to the specific portfolio of the bank in terms of the kinds of risks that the bank takes. This kind of regulation on capital adequacy varies to a large extent from bank to bank, depending on the type of activities that the bank engages in. Banks that have difficulty meeting the requirement have the option to adjust their loan portfolio, lend less or lend in safer ways, or raise capital in order to ensure that they have enough capital relative to risk-adjusted assets so that risk of going under for them is lower. While capital adequacy ratio requirement is a very important tool of controlling banking system and controlling risks, it is rarely used, however, for changing monetary policy or adjusting money supply or controlling the interest rates. The main consideration in the regulation of capital adequacy ratio is the cost of intermediation of the banks versus risks of bank failure. When the capital adequacy ratio is low, that means that the bank may face a lot of risks and may not be able to deal with shocks, negative shocks to its balance sheet, and may have to go under, which could have negative effects on the banking system as a whole. So that's a negative aspect. However, cost of intermediation would be lower if the capital adequacy ratio is lower, because capital is the most costly form of funding for banks, because it's very risky to have capital in the bank. If you lend to the bank and the bank has difficulties paying back, it's the capital owners, the owners of the bank, the equity in the bank, that gets hit first. And to some extent, that lenders are protected. Depositors are very protected. So that's the cheapest form of raising funds, because there's very little risk in it. So if the capital adequacy ratio is reduced, the central bank is letting the banks to finance most of their lending and most of their intermediation through debt, borrowing from other banks, borrowing from other financial institutions, or taking deposits. So that will lower the cost of intermediation. At the same time, it could be raising the risks of failure of the banks, and these two factors need to be taken into account, and the trade-off between them determines what level of capital adequacy ratio the central bank adopts. The discount rate is the interest rate the Fed charges, usually an overnight rate, for short-term loans to banks to deal with their cash shortages, or if they need liquidity very quickly. And you can figure out, think about what exactly would happen to the money supply if the Fed lowers the discount rate. So let's look at this poll, and I'm going to give you a moment to come up with the answer. It's pretty straightforward based on the discussions we've had so far. Suppose there's a meeting scheduled for next week, and the Fed lowers the discount rate. After the meeting, the banks would want to borrow from the Fed more money than before, less money than before, about the same, or we don't know, maybe more, maybe less. I hope you've chosen the option A. When the discount rate goes down, banks can borrow from the Fed more easily at less cost, and therefore they borrow more and they are able to lend more, and as a result there's going to be an increase in money supply. And you can figure out what happens to the money supply, and then you're going to see how that affects the interest rate. A few key points about the way the Fed controls the money supply. First thing to keep in mind is that the Fed's control over money supply is not perfect. The main reason is that the Fed may lower the discount rate or may provide more money through the open market operations, but when that money is deposited in the banks are the agents that decide how much of the deposit should be lent on. Sometimes they keep more reserves than required, and that affects money supply. So that's why the control over money supply is not perfect. But the Fed tries to adjust it in order to influence the interest rate. In fact, actively they try to fine-tune that supply of money in order to make sure that interest rates remain within the boundaries that the Fed is interested in. Another factor that makes the control of the Fed over money supply difficult is the behavior of firms and households. They may decide to hold more money or less money depending on their needs, about their perspectives about the future, their perceptions of what's happening in the money market.